Hello friends, today we are going to talk about financial stability report which was released recently by Reserve Bank of India. Financial stability report comes every 6 months in the month of June and December. So it provides the view of how the financial sector is operating, what are the financial strengths, and outlines the impending risks to the financial system. Broadly, it has three chapters: macro financial risks, global and domestic, financial institutions, soundness and resilience, banks, non banks, cooperative banks. It gives a very broad view of how the financial institutions are operating, what are the risks, what are the strengths, and how they should operate in future. It gives a lot of cue to the financial institutions, and it also outlines in the third chapter the regulatory initiatives in the financial sector. In the systemic risk survey, Reserve Bank of India has observed that major financial groups are in the medium risk category. It is a good thing that they have medium risk. Going forward, risks to financial stability include geopolitical risks, tight global financial conditions, capital outflows, exchange rate pressures, and the interest rate movements that are mostly expected as the inflation inches towards the targets of central banks. During the year FY24, the capital to risk weighted assets is at 16.8% as against 11.5%, that is the minimum required, so very comfortable as far as the capital adequacy ratio is concerned. And out of that, CET1, that is tier 1, is also equally remains above the benchmark, and even NBFCs are doing very well as of now. The GNPAs, that is the asset quality of the banking system, never gone so low as far as the gross NPAs are concerned. It is now at 2.74%, and net NPAs are at 0.6%. Both are at a historic low as far as asset quality is concerned. And one more good thing is the impending pipeline asset quality indicated by special mention accounts. Special mention accounts are divided into three groups: SMA 0, that is overdues up to 30 days, SMA 1, overdues from 31 days to 60 days, and SMA 2, 61 days to 90 days. SMA 2 is the most important because the next leg of SMA 2 is the probability of default. So SMA 2, the estimated impairment is just 1.8%. The other financial stability ratios have been very good. Return on assets are at 1.3%, and which is a 20-year high as far as return on assets is concerned, and return on equity is 12.3 in March 2024. The bank profits have jumped to 3.45 trillion in FY24. That is a 37.5% growth as far as the profits are concerned. The faster credit growth at elevated interest rate has been one of the underlying factors which has contributed. Of course, there is a cause of concern that there is a gap between the credit growth and the deposit growth, and going forward the financial institutions may have to encounter more liquidity risk unless they rejig their business distribution and they adopt better business models going forward. I think that is a separate topic which we'll be discussing, but net interest margin of banks has reached from minus 2.5 in 2018. If we can connect the dots, in 2018 the NPAs in the banking system was very, very high. Gross NPAs have reached 11.5% in March 2018, which have now come down to 2.8%. That is what the data now says. NIM also has gone up from minus 2.5% to 3.2%. 3.2% NIM is a very good indicator that the banks are doing very well, and the credit costs are also going down from 2.5% in 2018 to 0.5%. When we look at the non-capital adequacy ratio of NBFCs, it is at 26.58%. So even NBFCs are doing well, because as against the minimum requirement of 15% as far as the capital adequacy is concerned, the non-banks are having capital adequacy ratio of 26.58%, and their gross non-performing assets are at 3.96%. So when we sum up all these indicators, the banks and the NBFCs have recovered very well in the post-pandemic period after 2022 onwards, and they are now at a prime as far as the strength of the financial system is concerned. But there are few risks which they will have to manage going forward, and they may go up going forward. First and foremost is the liquidity risk, because they will have to focus more on mobilizing deposits, because the deposits which were coming to banks are now going to non-banks, because the corpus of mutual funds have reached 60 trillion. That is a very recent landmark which it has reached. So almost, and even insurance sector is very, very aggressive, and non-banks are very, very aggressive. Lot of IPOs are coming. So there is a lot of buoyancy in the financial sector, which is driving away some portion of banks' deposits to the non-banks, which the banks will have to be watchful. So the first and foremost is the liquidity risk. Second is the interest rate risk, because the interest rates, when they start going down, as the inflation touches the target of 4% in India, then I think there will be a shift in the whole interest rate risk management system, because some of the loans which are linked to the benchmark, they will be getting repriced very fast, whereas the deposits will not get repriced that fast unless the term deposits, and recently term deposit interest rates have gone up, so they will not get repriced so quickly unless the deposits mature. So there will be an interest rate risk, liquidity risk, interest rate risk, and operational risk is another big risk, because the technology playing a big role in steering the banking operations, and the cyber security, and the kind of frauds that are taking place in the space of digitization. I think a lot of focus has to be on financial literacy and digital literacy, so that the consumers remain protected, and all the stakeholders are very much concerned about the safety and security of the stakeholders' interest. So those aspects will have to be seen. So my dear friends, the financial stability report of June 2024 is giving us a very good opinion about the financial sector. They are very, very robust now. The challenge will be to protect the robustness, and to see that they contribute to the growth of the economy by lending, by creating resources, and they have to remodel their business models to ensure that they do better and contribute to the growth of the economy. So we will be talking more about important topics as we go forward. If you have not yet subscribed to the channel, please do subscribe, share these videos among your friends. And the very purpose of running this YouTube channel is to disseminate knowledge to the next level leaders, and to ensure that we provide you capsule information about the financial sector developments, so that at one glance you can get quick information on how the developments are taking place. So until we meet in the next video, thank you very much, and remain tagged to this YouTube channel.